Hello, all. Welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. We're going to be discussing some of the top ETF movers and shakers in the last few months and the prospects for the second half of the year. Our guests, as always, we've got the best in the business. Dave Nadig, of course, you know, Chief Investment Officer over at ETF Trends. Phil Mackintosh is Nasdaq's Chief Economist and all-around ETF expert as well. Phil, let me start with you. You sent us a list of some of the top 25 ETF movers, not just by price action recently, but also by flows, which is also an interesting way to look at things. It's a strange group. So it includes airlines like jets, which is attracting ridiculous amounts of attention given the size of it. The financial services ETF like IYG, small cap ETFs getting a lot of action, SPSM. You mentioned, and even ESG ETFs like ESGE also are moving. Tie this into a bow for us and make some sense of us. Airlines, banks, small caps, ESG. What are investors doing right now?
Yeah, I mean, I think we've been watching this top 25 list since the coronavirus sell-off started, and you've really seen a cycling of investor appetite. Obviously, back in March, when everything was a rush for cash, there's a lot of trading by the experts that use ETFs, and it's sophisticated retail as well as sophisticated hedge funds looking at the bond ETF. And then we sort of moved as we realized that the energy complex was going to be suffering from a lack of demand into the energy complex selling off. But as we've started to get back to work and we've started to look at this recovery trade, you've definitely started to see some different ETFs trading. So around about a month ago, we were looking at construction ETFs. Financials started to pick up just because financial ETFs had sold off, and some of the provisioning that had came through earnings in Q1 was really pretty significant. And people were worried that the original coronavirus shutdowns would lead to credit crises. Now that we're getting back to work, that's started to alleviate. But what we're seeing, I think, in the last week or so is actually some reversal trades of multi-year trends. So if you look at the performance of value over growth, growth has beaten value year after year after year, pretty much since we came out of the credit crisis. If you look at US markets versus international, the same sort of thing over an even longer time frame. And then again, with large cap, like large and mega cap stocks have really led this rally. And so what I think we're seeing in some of the trends this week is some of the people putting on bets that those trends that actually stretched during the coronavirus sell-off might come back. So we've seen value, and we've seen small cap, and we've seen a lot of trading into international markets because they've been stretched on the downside, probably oversold. And as we see people getting back to work, as we see Europe's getting back to work and not seeing a case spike, it makes sense to start to think about whether those economies might recover a little bit more quickly than the US market.
Yeah, a lot to chew on there. Dave, Phil was mentioning retail. I'm loving all this attention that Jets is getting. This is the airline ETFs, which, as you know, is ridiculously small and whose assets under management has exploded in the last 6 weeks, largely around a publicity associated with Robinhood, that the millennials seem to be trying to pick bottoms in certain things like airline ETFs. Explain the zeitgeist here. What's going on? Wrap up Robinhood and millennials and ETFs for us.
Well, you know, this website called Robin Track came out, which lets us actually track the number of holdings, not the dollar value, but how many accounts hold different stocks. And we've seen things with USO when people were trying to call the bottom in oil. We saw that with jets when people were trying to call the bottom in airlines. Now, I think it's a mistake to think that the $1 billion that has flowed into this fund is all mom and pop investors. That's not what we see in the 13F filings. It's not what we see on the tape. It's clear there's some very sophisticated folks out there, most likely hedge funds, using this. It's a well-constructed fund if you're trying to play the airline industry. There's nothing to fault with it. So it's not surprising that we're seeing a lot of bottom fishing here. We're seeing it in every sector that got heavily beaten up in the worst of it in March, whether that was in the energy, some of the financial services stocks, and all the trends that we just talked about really play into that. You know, small caps, we just had the Russell cross that's 200-day moving average to the upside. You know, when we talk about financials, we're seeing a bunch of those stocks come back. Value, all of these are, as Phil pointed out, these kinds of reversal plays. And sure, there's definitely some retail participation there, but I think it would be a mistake to think that this is just, you know, pajama pants traders.
Well, you're right, Dave. Of course, we point out that it's very likely that professional investors are using this to even as a shorting instrument
Sure.
for the airline industry. I think part of the problem is we can't really get our hands around retail participation. It's very difficult. We use partial data, not anecdotal, but partial data like the Robinhood data, which makes it available. We can get Ameritrade sometimes to comment on flows in their ETFs, but we don't really have good data about who is exactly buying what. It's all a little bit piecemeal. Phil, have you had any success parsing this out? We're always interested in what the, as Dave was saying, the professionals coming in who are either going long or shorting something like the airline ETFs versus, everyday investors and what they're actually doing. Have you any success pulling apart that thread?
Yeah, I mean, there's a couple of different ways to attack that. I mean, obviously, in the Q1 earnings, the retail brokers talked about the record number of new accounts that they've seen opened during the coronavirus, and they've seen a sort of increase in new accounts since they went to zero commissions as well about 6 months ago. But there's other data you can look at that's by ticker. It's a couple of weeks to 4 weeks delayed, but what you tend to see actually is retail like to trade less liquid stocks. It's the hedge funds that tend to trade the super liquid ETFs. So all of those sector spiders and SPY and IWM and EEM that you hear about all the time are often really actively traded by market makers and hedge funds that are sophisticated. They may be long, they may be short, but they're pretty actively traded. But these days, there's such a huge complex of smart beta ETFs with really interesting thematic exposures, and you tend to see retail going in and out of those more.
Yeah. Dave, I haven't had a chance to talk to you in the last few weeks since all the demonstrations for social justice have been going on. We're continuing to see inflows into ESG. I know that this is only tangentially ESG related to social justice issues, but it's the closest thing we've got. I'm wondering if you can comment on that and whether this will give additional push to ESG and maybe put a little more emphasis on the social and governance part of ESG rather than just the environmental, which a lot of people seem to have emphasized in the past.
Yeah, there's no question. We talk to advisors every week in our practice, and we're hearing from them over and over again. They want to understand how to present ESG to their clients. They want to be able to have that conversation. And the honest truth here, Bob, is there's always a catalyst. The catalyst right now is what we're seeing in terms of the Black Lives Matter movement and the social unrest issues. And those are very real, and they do get some focus. But when we're talking about broad ESG funds, it's important to point out these aren't one-size-fits-all products. Some of these funds are very much market-like with small tweaks. Some of them are very, very specific to women in governance or very specific environmental causes. So I think the important thing is the interest is there. We're seeing the flows for the first time. And like everything else, you really have to do your homework, whether you're an advisor or an investor, to understand whether the values you're trying to project through your investments are actually captured in that strategy.
Yeah, Phil, just give me 20 seconds on that and your thoughts. How do we get that the demand for social justice that is so prevalent today and so right to be concerned about? How do we get that showing up more in not only stock picking, but I guess ESG in general? I'm asking the same question, more on the social and governance part rather than as much impact or emphasis has been in the past on environmental.
Yeah, I mean, it's a chicken and egg debate in a way. What you want is so much money chasing those good factors that the corporates themselves want to project better factors and behave better. In Europe, they're actually further along on that track. They've got a lot more ESG money tracking those funds. And once you get that, you start to get people buying the stocks because they've got good governance or good social or good environmental policies. And that's what you really need.
Yeah, I'm just hopeful that the people who construct the ESG, remember, those are constructs and there's weightings in them, whether the weightings on social justice issues become equally as important. As you guys know, you can construct these any way you want, weight them any way you want. I want to move on here, though. Dave, just talk about the treasuries. It's amazing me. The last few days we've had sell-offs in treasuries, yet I still see inflows into the corporate bond ETFs, that LQD, the high yield ETF, even HEG, the broad one. Dave, they just seem to keep loving them.
Yeah, if you look at the top 10 list
Bond
for
ETFs.
flows last week, almost all of them were bond ETFs. And now, obviously, some of this is still a reaction to Fed buying. We get that data delayed, but we know that funds like LQD, HYG, Vanguard Short-Term Fund, VCSH, JNK, these are the funds that are being used by the Fed. It's putting a bid underneath the entire market. We're seeing much less in treasuries, which is understandable, but I think it's also important to remember investors don't have much choice, right? Unless you're literally going to take all your money and stick it in a mattress, you're going to be looking for some place to park that money. And so when this money is coming in off the quote unquote sidelines from March, from April, it has to go somewhere. So it doesn't surprise me we're seeing it into these more safe haven assets or these yield hunting assets when we're talking about corporates and high yield. Heck, we had a $1 billion week last week in GLD as well. None of that surprised me. We're seeing this money come back to work.
Yeah. I want to just move on, Phil. One new ETF just kind of caught my interest, and that's the sports betting and gaming ETF, BETZ. It's 3 days old, and yet there's all sorts of press surrounding this thing. It's basically a sports betting ETF. It's got DraftKings and Penn National Gaming and GAN, the software company that does a lot of gets its revenue from the gaming industry. It's not that interesting to me, and yet it's been around 3 days. It's getting all of this attention, inflows, and of course the Robinhood crowd is very interested in this. Can you illuminate why the world is so interested in gaming, or just millennials like sports gaming? Maybe it's that simple.
Yeah, I mean, it's definitely a defensive play, I guess, right now as well. But it just highlights to me how the new ETFs that are coming out are fairly active and really quite interesting thematics. And so when you find a thematic that the sort of investor public wants to have exposure to, you get some money flowing into it. And that's one of the things that we've seen with a lot of the smart beta ETFs over the last sort of 4 to 5 years is they've been attracting a lot more assets relatively than all the boring index funds that were older and around for longer.
Yeah.
Yeah, and I would just comment that, I think this like what we saw with, say, ESPO or the esports ETFs, these are capturing investor attention in a way that very few other things do. Frankly, I could come up with some smart beta ETF based on a great quant model that might perform really well. And it's not as interesting for an average investor than to say, hey, you know what? Everybody's trapped at home. We're all trying to figure out what to do. We're all hopeful that we're going to be getting live sports back again. This makes a ton of sense to me, just like the esports ETFs have as well. And I think in a lot of ways, thematics are the new factors. It's how investors are thinking about dividing up the market. And with ETFs that can really invest globally, you can capture these things. Because if this was a U.S.-only fund, this would only have 2 or 3 names in it, DraftKings and Penn National, that'd be about it. But because it can capture, Britain, Australia, Ireland, Malta, you name it, you really do get a pretty pure play on what seems like a pretty narrow corner of the market.
Yeah, I agree. They used to say, invest what you know. That was that old saying in the early 90s. And thematics has sort of become that. So what do people want to invest in the market know about? Well, you know about airlines. They want to go places. You know about sports betting because that's what they want to do with their friends. And so it makes some sense. I think maybe we're overanalyzing a little too much. The answer is fairly obvious, but I think you're right. Thematics is the way people play, invest in what you know. I just want to move on, Dave and Phil, talk a little bit about active non-transparent ETFs. I keep getting these emails. Active ETFs are finally here. Non-transparent active ETFs are finally here. Fidelity became the third asset manager, I think, after American Century and Legg Mason, to launch their own actively managed non-transparent funds out there. They launched 3 of them last week, all essentially based on existing Fidelity actively managed funds. They're not exactly the same, but let's not get too crazy about that. Phil, active non-transparent and just active ETFs. I know you're in the ETF business, but we've been saying for years something might happen. There's a few of them now launching. What's your take on this and whether or not we're going to see significant money flow into this space at all?
Yeah, I mean, it was an evolution of the sort of mutual fund industry that was a gap that needed to be filled for a long time. And now that they're approved, it really doesn't surprise me that there's people coming to market with these ETF products that are copycats of their well-known mutual fund products with a track record. It's a different distribution model, essentially. You've got these Robin Hoods and robo-advisors that are putting ETFs into people's portfolios, and if all you offer is mutual funds, you don't have access to that customer base. So just being able to clone your mutual fund into an active ETF, I think opens up a whole distribution arm. But also, we've had active ETFs for a long time. It's not like active itself is new. We've had transparent active, we've had these smart beta funds, and they've protected investors, and they've been great ways to get exposure as well.
Yeah. Dave, are we, does anybody, is this a big deal, or should we stop caring so much about it? I know the industry cares. The mutual fund industry does. They want a way to get out of those high-cost funds and into an ETF product. Go ahead. Sorry.
Right. People who are selling them think it's a big deal. Look, the structural issues here are interesting for nerds like me, but they're largely solved now. We've now got multiple structures that are out there trading. They're all trading well. They're all trading close to fair value, and they're all trading with decent spreads. So the question about whether or not these products would, quote unquote, work, I think is solved and is no longer interesting. Now the question is, does anybody actually want these strategies? You look at Fidelity's recent launches, two of them are blue chip growth and blue chip value. Those are such vanilla strategies, even if they're actively managed right now, that it's surprising you'd even bother to put them in a non-transparent structure. I mean, is Fidelity really worried people are going to front-run their position at Salesforce.com? I mean, that seems a little silly, right? Where it does make sense would be, frankly, much further down the spectrum, or with something that's really a name brand like a Magellan or a Contra fund. So I think what's next here is the marketing angle. I'm dying to see one of these companies come out with a real big brand name fund that people will really understand. Like, we need a Growth Fund of America and an ETF wrapper to really understand whether that's going to drive flows, because right now we haven't seen big flows into those funds that are out.
Yeah. I would agree with that, and my position on these actively managed or non-transparent actively managed, I don't care what you call them, if you have 30 mutual funds that are underperforming their benchmarks and you turn them into 30 ETFs, just because you charge 25 basis points less does not going to suddenly turn them into winners. What they want is people who are actually really outperforming and have a following. And I agree with Dave. I think it's what you're saying, Dave, is if you could find people like a famous Magellan fund, like a Peter Lynch or somebody like that, that is out there, that is actively outperforming, and you could put them charging 150 basis points into an ETF that is charging 50 basis points, just as an example, then you might have something. But en masse, moving whole mutual funds classes into ETFs is not going to necessarily create a lot of new inflows. Guys, we're going to have to leave it there. A very interesting discussion. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave and to Phil, experts, both of them, for joining us today. Thank you for watching. You can watch all of our latest videos. We've got a whole library of them. etfedge.cnbc.com. We're back next Monday, same time, same place. Everybody have a healthy, happy, and safe trading week. Back to you.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.